Steve Hanke joins us once again. He is a professor of applied economics at Johns Hopkins University and a globally renowned economist and expert on monetary policy and currency reform. We'll be talking about the Fed's latest decision, as well as some headlines making the news on the latest economic data and taxes and budget changes in both the U.S. and Canada. Welcome back to the show, Professor.
Great to be with you, David. Thanks for having me.
Oh, no problem. Thanks for being here. Some viewer questions as well we'll address as usual. A lot of good questions came in. Won't have time to go through all of them, but I'll pick a few. Something we haven't talked about a lot, central bank independence. This is a topic that came to the forefront as I was reading the Wall Street Journal earlier last week. I'll just read the first two paragraphs here. Donald Trump's allies are quietly drafting proposals that would attempt to erode the Federal Reserve's independence if the former president wins a second term. The group of Trump allies that have been secretly drafting this proposal argues that he should be consulted on interest rate decisions. In the draft document, recommends subjecting Fed regulations to White House review and more forcefully using the Treasury Department as a check on the central bank. The group also contends that if Trump wins, he returns to the White House, he would have the authority to oust Jerome Powell as Fed chair before his 4-year term ends in 2026. What's your initial reaction to this?
Well,
Obviously, this is.
I have a variety of reactions.
Okay.
One is that this apparently now my friend Steve Moore, who's as you know one of the Trump advisors,
Yeah.
has been adamant that that this document doesn't exist.
Okay.
This is basically, at least according to Moore, which I have no reason why he wouldn't indicate this, is fake news.
According to this article, again, I'm just citing this article.
No, I know.
It's so secretive that that Trump's close advisors don't even know about this.
Well, okay, so let me just react to it. One is that Steve Moore is a pretty close advisor,
Sure.
and Steve has indicated that the document doesn't exist. There is no such document. So that's one side of the story. Let's assume there is a document, and that line of thinking. Well, where would that come from? If you go back to a few years ago, there was a movement called Audit the Fed, and the Audit the Fed. All that said was that there would be an outside audit of the Fed, what the Fed is doing, and audit their policy actions and so forth. Now, it turns out one person behind Audit the Fed happened to be Art Laffer. And Art Laffer definitely is a close advisor of Trump. And therefore, there is kind of a scintilla of plausibility in this. You see what I mean? But years ago, when Audit the Fed came up, Laffer was one of the leading people. So let's keep on with this. Where was Hanke on this? Hanke was supporting the Audit the Fed. Why wouldn't you want to audit the Fed? We audit private companies. Why wouldn't you audit something the government was doing?
Are you suggesting that there is currently no audit system in place for the Fed?
No, there's not. No, there is not. There isn't a broad audit of the Fed and their policies and what they're doing and so forth. No.
What is your proposal?
And that's why that legislation, by the way, never went anyplace. It never passed. But just having it out there, and of course with the Fed pushing back in it, doesn't that suggest that they wanted to look under the hood with this Audit the Fed legislation more carefully than they're looking under the hood right now? That's what it meant. The Fed doesn't want anyone looking at their business, and that's why they use this mantra of independence, as if the Fed really is independent. I mean, this is kind of a de jure they might be, de facto they aren't. The Fed is influenced by lots of people in Washington, not only the White House, but what's going on Capitol Hill and so forth. But so that's the kind of background. I wrote this up. By the way, I can't remember the. I think it was in 2019. I wrote a Forbes column about this. You can Google a thing probably and find it on Forbes. I think my article is something like "Audit the Fed" or something like that. And by the way, one person who was we don't know how Milton Friedman would have reacted to that particular legislation because Milton had passed away and gone to the other side by the time that legislation came up. But my interpretation of Friedman, what Friedman, he would have been for it.
But
The dean of the quantity theory of money was for transparency. That's all it was. It basically,
practically speaking, though, how does an entity audit the Fed? How do we go about doing this? Do you have a proposal in mind?
well, yeah. Look at the draft legislation. It's all laid out in that old statute that didn't pass. Now, one thing I would propose and want in there, if I was doing it, I would change the rules and we have an inflation target. It happens to be 2%. And you could have, plus you could have between 1 and 3%, a range. And if the Fed didn't hit that, the governor of the Fed, the chairman of the Fed, excuse me, and the governors could be replaced. That's what I would do. That would make them responsible. You force them to hit the inflation target.
Okay, but going back to this Trump document, first of all, it's not official, right? Trump has to sign off on it if he were president, and
Well,
nothing's been made official.
first there has to be a document.
Okay.
There apparently is some. It's a little bit contentious, and by
Yeah.
the way, I don't think there probably is, and I'll tell you why.
Okay.
Right after this thing came out in the Wall Street Journal, the Financial Times contacted me and asked me if I knew about the document. If I had no, they asked me if I had the document, if I'd seen it, and I said I'd never even heard about it. And then I sent the Financial Times my old Forbes article about audit the Fed and gave them my views on the whole thing. But I've noted there's nothing that's been reported in the Financial Times or any place else on this.
Well, again, according to this article, it's very secretive. Not, yourself or Steve Moore or anybody close to Trump wouldn't know about this. But that aside, let's just discuss the
Who
concept
wrote
of
it? Who wrote it? If no one close to Trump,
we
Trump
don't
doesn't
know.
Trump is in the middle of a trial right now. How in the world would he be having time to write this thing himself?
Okay, well, that aside,
that's not how politics work. Somebody had, if there is a document, it had to be written by people close to Trump. That part we know, and at least the people close to Trump that I know claim that the document doesn't exist. Now maybe they're trying to hide something. I don't know, but why would they? Why would they put their reputations on the line and say it doesn't exist when it does exist? And then somebody's going to come out with a document.
Do you like the idea? Just forget Trump or Biden or whoever. Just do you like the idea of a sitting president being on the board of governors, even on an acting basis?
No, but I like the idea of more transparency and auditing the Fed. Per the old proposal, and the old proposal, the fundamental issue at that time with audit the Fed was the following: the Fed took the position that we are an independent body. We're up in the clouds someplace. We're not influenced by politics. We're completely independent. And no one has to know what we're doing, et cetera, et cetera. And the other side, which I was on, which Art Laffer was on, which I'm sure Milton Friedman would have been on if he would have been alive, was no, we want some transparency. How's policy being formed and what's going on?
This is just an aside. This is getting conspiratorial, but there's some people who believe that there's no gold in Fort Knox. I'm just tying that into the audit the Fed argument that we're having because nobody actually went in there.
Yeah.
and actually, and did a full audit on that.
Yeah, yeah. You're David. You're really it's late in the afternoon for you in Vancouver, but you're really getting out in the weeds already.
Just looping that in. You
Eh,
can comment or not. I'll leave it up to you. Yeah.
well, no. By the way, the federal government it is audited, and
Yeah.
according to the according to the audits, the gold is there.
Okay. Fair enough.
According
Um,
to the audits, the gold is there. So you can have as many theories as you want, but
so you do think that an election year, which is what this year is, would have some influence on Fed decisions? Yes or no?
well, what? Yes, yes. Everything has influence over the Fed decisions. Well, I said they're data dependent. So what are they? They're looking at data all the time, and that's influencing their decisions.
But are they looking at, okay, let me just be a little bit more direct. Is somebody from the Biden administration calling Jerome Powell and saying you have to lower rates soon?
I I don't know, but there are ways that messages are passed back and forth.
Right.
The Fed knows very well what the White House thinking is on this. I mean, let me put it that way. I doubt if Biden's been around enough. He's an old enough veteran. I shouldn't use the word old. He probably wouldn't like that, but he's been around. He's been around long enough, and he's not stupid enough to pick up the telephone himself and call Jerome Powell, for God's sakes. Can you imagine what a stupidity that would be?
Well,
They just don't operate like this.
sure. Fair enough. By the way, you are we've scheduled to have you appear on panels with both Art Laffer and Peter Schiff later in May. So for
Oh,
the audience
yeah,
watching, stay tuned for that.
that'd be great. Well, we can bring this topic up with Art because
Yes. And I understand you guys, well, you two have met, you close old friends, right?
yes. Now,
Back
Art
in the
and by the way, the lead paragraph in my Forbes article is about Art Laffer and his position on this. That's the first. That literally is the first paragraph of that article.
Okay. Yeah, I think you have similar views on many things, so it'll be an interesting panel to host. That's coming up in a couple of weeks, mid-May. We're going to continue with Professor Hanke's analysis on inflation, but first, a word from our sponsor, iTrust Capital, an IRA that offers 35 crypto assets and the lowest trading fees in the crypto IRA space at just 1%. If you're over 18 and you'd like to open a new account with cash or roll over an existing account, click on itrust.capital/David or scan the QR code here to learn more. And if you fund your account using my referral link, you can get $100 in signing bonuses once you fund the account. So let's move on now to talk about these capital gains tax increases that have been proposed in both Canada and the US. In Canada, it was up to 66%. Now, in the US, it was 44.6%. I don't think they've been passed yet. They have to be voted on. But at least where I am, there's been a lot of debate as to whether or not this will do any good or significant damage to the economy. I'd like to get your take. What will this do ultimately for not just investors, but for the everyday person living in these countries?
Well, for the everyday person, if you look at who holds the stocks in the United States, I'm not speaking of Canada. It's more or less the same in Canada, but 72% of all stock in the United States is held by pension plans. So who's going to get hurt? People who are on pensions. They're going to have their wealth snatched away from them if you increase the capital gains tax. That's where the thing hits. And by the way, you said the proposal is to jack the headline rate up to 44% in the United States. On an inflation adjusted basis, it's already that high in the United States. So by making the statutory rate go up even higher than it is at present, it'll punch that rate, inflation adjusted, even up higher than it already is. So it's a bad idea in both places. It hurts pensioners. It hits pensioners very hard.
What impact, if any, does this have on inflation? Presumably, if you raise the tax on not just goods, but in this case, capital gains, would this have any trickle down effect on ultimately consumer prices?
Probably not.
Okay, so
Number one, the total amount of revenue taken in by the these capital gains taxes is not that great in terms of the total magnitude of taxes that are taken in. So the only way it kind of could indirectly, theoretically affect inflation is if it somehow generated more revenue, which by the way, that's very questionable, whether raising the rate actually would increase the revenue. Let's just assume the hypothetical that somehow it would magically you raise the rate and that would lower the excuse me, you raise the rate and that would increase the amount of revenue coming in. Well, that revenue is kind of a drop in the bucket, whatever it would be, and that wouldn't really affect the federal deficit that much, and that's where the inflation rub comes. If somehow you reduce the deficit, there's less pressure on the Federal Reserve to impose an inflation tax and basically inflate the debt burden away. So it would be a very questionable. It's all questionable. I would say off the top of my head, you can forget the inflation argument. It's not going to make much difference one way or another.
all right, so forget inflation, but is raising taxes overall, not just capital gains taxes, but income taxes, corporate taxes, is that the correct approach to fighting or bringing down the deficit level?
No, of course not. The correct approach is to, if you want a healthy economy, is to bring down government spending. Government spending has been the killer in this, or in the United States. That is the main source of the increased and sustained deficit that we are witnessing in the United States, and the record level of debt to GDP. And by the way, by reducing government expenditures, you kill two birds with one stone. You not only reduce the deficit or eliminate the deficit, but also you eliminate the crowding out of the private sector by the public sector. It's government spending that does the crowding out.
I have to set you up to debate another professor I spoke to recently who takes the other argument, which is that we should be raising taxes. But just generally speaking, I'm not here to debate you, and neither is he. But
well,
why would you take the side of reducing spending versus what's wrong with raising taxes?
Because I'm against waste, fraud, and abuse, and that's what accompanies the increased government spending. And the increased government spending, I want a larger private sector, not a larger government sector. And if a larger government sector is just going to reduce productivity, reduce growth, reduce prosperity in general, reduce people's real income. I'm for having a higher real income per capita, and you get that by what? Innovation and entrepreneurship in the private sector. You don't get it in the public sector. Why do you think Europe is on its knees almost? Their projected growth next year in Europe is in aggregate less than 1% on average in the European Union. Why is that? Because you have these huge government monsters where, like France, the king is spending 56% of GDP in government spending. All of the European countries have much higher levels of government spending relative to GDP than in the United States, and they grow more slowly. I don't think that's good. That's bad. I want incomes to grow fast, not slowly.
The liberal argument is that we can just raise taxes on the very rich and the large corporations, on the billionaires and multimillionaires. It wouldn't hurt the rest of the population, but it would it would help alleviate some of the debt or deficit burdens.
Well, the rich are paying a disproportionate share of the taxes already. So, that's an income distribution kind of argument, not necessarily a growth kind of argument. And what happens when you tax people more? They definitely work less, and they save less, and they invest less, and all that's bad for the economy. Plus they move around. Those in states where they have high progressive personal income tax rates do what? Well, they move out of those states. They move to places like Florida or Nevada or Texas. So people aren't just static. They're not going to stand still. If you, it's basically supply and demand.
Well, we understand the theory, but can you draw on some examples for us?
Yeah, just look at the United
For
States. Look at the states that are taxing heavily. California, people are moving out. New York, people are moving out. And where do they go? They go to places where they have low tax rates. Florida, Texas, Nevada.
what's the relationship between taxes and productivity?
Well, if there's a big relationship, because if you tax, you don't, people don't save as much and they don't invest as much. And if you invest less and are putting less capital into the system, your productivity is going down. The taxes are. This gets back to, remember, I was on Reagan's Council of Economic Advisors, and Reaganomics and supply side economics. We went through all of this stuff in the early 80s. We'd reached in the 70s a point where we had, remember something called stagflation? That's what we had in the 70s. And what happened? Reagan came in with Reaganomics and slashed personal income tax rates, corporate income tax, capital gains taxes, and the economy started mending itself. And by the time we got in, particularly to the 90s, the real beneficiary of the thing happened to be President Clinton. A lot of these benefits came from the reforms and taxes that were done in the 80s, the lowering of all these tax rates, and boom, we had a great decade in the 1990s. And by the way, Clinton, among other things, Clinton wasn't raising taxes; he was doing reforms. You had Clinton, the last 2 years he was in office, actually producing surpluses. There weren't deficits in the United States. We weren't talking about a deficit problem. Everyone was wringing their hands. They said, oh, the government's not going to be issuing any bonds anymore. The bond market's going to dry up because Clinton's running surpluses. Clinton was in fact, and it was a combination. You had Clinton in the White House, and you had Newt Gingrich, who was Speaker of the House. You had two smart politicians involved in the thing, and what happened? You had a booming economy. You had Alan Greenspan was at the Fed, so you had a real boom in the 1990s. Plus the fact, by the way, we weren't engaged in new wars like now. Biden has we've been drug into two wars, and we're financing those. Clinton was benefiting from the peace dividend. Remember, the Soviet Union collapsed. We had a huge peace dividend that was a beneficiary, the big beneficiary politically, and that was President Clinton. But in fact, he left this supply side economics regime and overlay in place, and you had pretty much good monetary stability with Alan Greenspan. He was following Hanke's golden growth rate rule for the Fed. The money supply was, growing at a pretty steady rate around 6%, a rate consistent with hitting an inflation target of 2%. So So at any rate, we've been through this before, and the evidence of how bad these ideas are. Look at the 1970s and the trouble we got into in the 1970s. All these tax increases eventually produced what? Stagflation.
Okay, so that all right. Well, have to get you on a panel with somebody who takes the other side. But for now, we'll just
Well, you better tell who the other side is. They better bring the ammunition along because I think they're going to be shooting a pea shooter.
we'll stay tuned for that. That would be fun to moderate. I have a viewer question I'd like to address with you. He says, I'm aware that inflation is causing variable and leading nonlinear changes in the money supply. Just wanted to inquire about the recent moves in the M2 money supply, and if Professor Hanke still maintains the view of 2% inflation by 2024, and considering year-on-year increases in the money supply have actually flipped positive for April 2024. Is this a signal that Federal Reserve monetary policy has been too loose and that the Fed funds rate will need to go much higher? The past 6 months of inflation data would suggest this. Well, let's just break it down one piece at a time. I think there's several questions in this. First of all, yes, M2. If
Yeah,
you take year over year M2, it's
by the way, it is a good question, but let's break it down.
yes, year over year M2 has been climbing. It's now at negative 0.3%. It was much lower at negative almost negative 5%, negative 4.5. So does this mean that inflation's coming back?
No.
Well, the M2 year over change is
Yeah,
climbing, is not.
yeah. It's basically stabilized after falling. And if you look at what's happened over the last year, it's negative. I mean, it's contracted. The money supply is much less than it was a year ago, and when you have these contractions, which are very unusual, by the way, we've only had four contractions in the U.S. history, I should say, in the history of the Federal Reserve since 1913. And each one of those contractions did exactly what the quantity theory of money would predict. We had a recession. So that's why getting into the quantity theory of money, if the money supply, the fuel for the economy contracts and it is negative on a sustained basis, which it has been, you ultimately are going to get a recession, and it's baked in the cake. The problem is, well, when will this occur? And just to clarify on this, remember some time ago, John Greenwood and I actually initially, once this negativity crept into the system, we thought that the recession would hit much earlier than it's going to hit. We thought that it would hit by the end of 2023. Well, we know it didn't hit. We're already past that date. And now we think that late in 2024 or early 2025, it's going to hit. Right. And it'll work its way through the system and eventually hit. That's why I use this expression, it's baked in the cake.
Yeah.
Because you get a big change in the money supply, and David, there's a long and variable lag between that change in the money supply and when the economic activity starts changing. And the reason we were off on our initial forecast was because we built up such a huge excess of cash balances in the economy. And what is that? You can calculate it. Go to the St. Louis Fed statistical thing, and you take M2 and just divide GDP into M2, and that's a cash balance. And that thing went way up, and now that's all drained off. The excess cash balance now is all drained off. John and I thought it would be drained off much faster than it actually has been than we've witnessed. But that's the story on why we were off. But in general, people have to remember, money dominates. The quantity theory of money is the correct way to look at what's going to happen with the course of the economy and inflation. Now, what's the quantity theory of money? It just means that big changes in the money supply move things. And if you have a big boom in the money supply, like we did after COVID, when it peaked out in February of 2022 at 27% year over year growth, we've never had that before. That's the highest rate we've ever had in the United States since 1913 when the Fed was installed. And what did we get? We got a lot of inflation. Now, Greenwood and I predicted that exactly. Remember, we said would go up maybe as high as 9%. Well, it did go up to 9.1%. So we got that right. What we didn't get right is this business about the contraction. It started contracting, and we know eventually we'll get contraction in the economy. We'll also get contraction in inflation. So the viewer said 2% by the end of this year. It might take a little longer to get 2% because we've had 3 months of basically stable inflation. It hasn't continued on a linear path. The questioner said I think he had some phrase in there about nonlinearity, and he's correct. Things don't always move in a straight line.
If you think it'll take longer for inflation to come down to 2%, does that mean the Fed will likely keep rates higher for longer?
Well, yeah, yes, the way the Fed operates, number one, they don't look at the money supply, so they don't look at the right thing. They basically don't know what's going on. to make a long story short, they look at the current data. So they will look at all these inflation numbers and inflation measures that are coming out, weekly, monthly, and so forth. And if those kind of plateau out for a little while, as they have done, by the way, and if you listen to Powell, even today, chairman of the Fed, it's going to be higher rates for longer because the inflation seems to be kind of sticky. It's plateaued. Well, I think it is sticky temporarily, but what's baked in the cake is lower. It's going to go lower. And so the Fed might change their tune. If they see that thing going down again, my guess is they'll change their tune. They're always changing their tune depending on what the daily data are doing. Because they, unlike me, they have no theory about what's going on.
The Fed didn't change their rates this week, but what they did do was announce that it will significantly curtail its quantitative tightening program. In other words, taper the tapering. Will this have any impact on A, the money supply, and B, ultimately inflation?
Yes, it will. The money supply contraction that I've been talking about, it won't contract as fast.
Okay. So
it takes the contraction out of the thing. And I've been saying when we've discussed this, David, that they should have stopped quantitative tightening a long time ago.
Well, if they did that, how would they combat inflation?
Well, they've already combated it because of the contraction in the money supply that's already occurred. They've already overdone it. And it's coming down the pike. We just haven't seen it yet because there are long and variable lags between changes in the money supply and changes in inflation.
I think we've talked about this before, but this keeps coming up. You don't think a shock in oil would temporarily or perhaps even permanently cause inflation to reignite?
No. These are all ad hoc reasons, these various things like the oil thing. Let's go through oil one more time and go back to the 1970s. In the 1970s, we had two huge oil shocks, one in 1973 and then one later in 1979. Now, what happened? Everybody said, oh, the oil shock. Oil was going to the moon in 1973. And that was what was causing inflation. And that's why we had stagflation in the United States and Canada, places like that. Now, what did they do in Japan? Of course, the price, they were really hit with the oil price increase because they import all their oil. They're not producing oil in Japan. So the oil price goes up, and the Bank of Japan in 1973, they accommodated that increased price, that increased relative price in oil relative to everything else. They accommodated that by increasing the money supply. And sure enough, they got inflation. The money supply went up and they got inflation. In 79, they took a different tack. They said, oil prices are going up, but we're not going to cave in and accommodate that relative price increase. We are going to do what? Hold the fort. And they did, and as a result of not accommodating the increase in the price of oil, they didn't get a surge in inflation. The oil price went up relative to everything else in Japan in 79, but it did not cause inflation.
We have to talk about something that was brought to my attention again, the Cantillon Effect, named
Right.
after the 17th, 18th century
Yeah.
economist Richard Cantillon. What
Yeah.
is this? In theory, it's an uneven change in prices due to changes in the money supply. But I think we've talked about this in passing as well. When the money supply changes, not everything moves up and down the same way. But I'll let you
Well, that's
explain.
that. Yeah, that's what Cantillon said. That's the Cantillon effect. It's
Yeah.
uneven. In other words, Cantillon. There are two things about. There are several things about Cantillon. I'm a great devotee of Cantillon. Uh, this is his initial book that came out before The Wealth of Nations came out. Cantillon really is the first modern economist, not Adam Smith. It was Cantillon. He was an Irish aristocrat who fled Ireland and went to France. Was very involved, by the way, in banking in France, and a friend of John Law, or John Loss, as they say in French. The Mississippi Company. Remember, the first bubble we ever had really was the Mississippi Company, and Cantillon invested in that in the first place, and then he saw it was being financed by fiat money. John Loss, the first fiat money was in France, and it turned out Cantillon turned around and shorted the Mississippi Company. He made a fortune going up in the bubble, and he caught the bubble before it popped and shorted the Mississippi Company. So now that's the background on Cantillon. Great economist, great banker, great speculator. And what we have here is a case in which he in his economics, the Cantillon effect, just said that money is not neutral. Money does not enter the system and raise and lower all prices together in unison in a proportional way. But some go up first, and then others go up and down, and so forth. That's the Cantillon effect. And what we have, you can see that because what goes up first if money is injected in the economy? Commodity prices. Prices of goods go up first. Real estate goes up first. Asset prices go up first. And then we have it dribbling through the system in different ways, and service prices start going up. In the meantime, the general level, if we've increased the level of money supply, the general level of prices go up. But in the meantime, relative prices are moving all over the place. And that's what Cantillon was saying. Inject the money, and it doesn't affect all the prices proportionately. That's what it's saying.
What would go up first if we have an explosion of the money supply upwards?
Well, commodity prices go up in general. So this is, if you're a commodity trader, you learn how to watch the money supply very carefully, because the most sensitive prices in what we call a price system, the economy, are commodity prices. They're highly sensitive.
And the reverse can be said, can be true as well. If the money supply goes down, commodities are the first to go down.
Yeah, yeah, yeah. Why do you think that the last year? Why do you think commodity prices have collapsed? Why do you think that's happened?
I'm guessing
That
because the M2 supply went down.
Yeah, yeah, that's the contraction in the money supply. that's a very good example of precisely what we've been talking about earlier. You contract the money supply, and the first thing that collapses are commodity prices. They've collapsed. There are a few exceptions like cocoa. Cocoa's gone to the moon, for the last year. But that's just because weather conditions are bad, the crop's bad. They haven't been maintaining the plantations properly in Ghana, the Ivory Coast, and as a result, the cocoa prices have literally gone to the moon. Also, you've had like uranium prices going to the moon. Why is that? Because all of a sudden there's a lot of talk about, going nuke with power.
What about stock prices? Are those directly related?
Yeah, they are. They tend to come pretty early in the chain. By the way, that it takes about 6 to 9 months after a big change in the money supply, with asset prices start going up or down. And so asset prices include what? Well, they include all commodities, but also they include like real estate. Real estate's quite sensitive, by the way. Stock prices, quite sensitive. What happened after we had the big injection of money in the United States and in Canada and various places? The stock market and real estate went to the moon. In 2000, and following the explosion of the money supply, and after the pandemic, the stock market was up big time in 2021 and 2022. Everyone said, "Oh, we're shutting down the economy. The stock market's clearly going to crash." It did temporarily go down, but then boom, it went to the moon.
I get asked this all the time. Were these assets responding to the money supply, like you said, or the Fed funds rate, which was also coming down at the same time?
Well, no, they were responding to the money supply.
Okay.
The driver thing is the money supply. The best indicator of monetary policy is not interest rates; it's the money supply.
We don't have time to talk about this today, but apparently in Argentina, a country you're well familiar with, they're posting a budget surplus. We'll talk about that next time. I don't know what happened there, but yeah.
It's very easy. They just stopped paying. I mean, no, that one's just plain vanilla. I mean, if if you stop paying, that's one way to get a surplus in a hurry.
All right.
Because there is a trickle of revenue coming in, and if nothing is going out, they call it a surplus.
I guess that's one way to define it. Anyway, a topic for another time. Have a good evening, Professor, and we'll see you soon.
Are you suggesting there's another way to define it?
Well, I mean, maybe they're balancing the books better. I don't know. They're
Okay.
more revenue. They're getting more revenue. That's another way to look at it. But
No,
I don't know
not,
if that's the
not
case.
really getting more revenue. They're just not spending anything.
Okay.
If you have an input, you have revenue coming in, and if you have more going out in government expenditures than it's coming in, you have a deficit. And if you have less going out than it's coming in, you have a surplus. And that's what they have. They have a surplus because they just stopped the outflow.
Well, I do know that they cut somewhere around 15,000 government jobs.
Yeah,
So
they cut government jobs. They stopped transferring money from the federal government to the provinces, and bingo, magic. Everyone's surprised. They have a surplus. I don't know why anyone's surprised.
finally, Professor, where can we follow your work now and learn more from you?
You can follow on Twitter, or X now, as it's been renamed, uh, after Elon Musk took over the operation. It's at Steve_Hanke. And I've got now 729,000 followers, the third biggest following of any economist in the world. So that's the quickest way. Otherwise, if you want longer articles and things like that, I have a distribution list, and you can just email me at Hanke, Hanke, at jhu.edu. That's my university email, and I'll respond, put you on the mailing list.
Okay, we'll put the links down below. Please do reach out to Professor Hanke if you have a question for our next episode. Our next two appearances together will be panels with Art Laffer and Peter Schiff.
Oh yeah, that'll be great. Those will be great sessions.
Have a great night, and we'll
Yeah,
see you
thank
soon.
you. Great to see you, David.